Hello everyone, I'm so thrilled to be here today. This is the last session before lunchtime and we are going to have you hungry not just for food but for investing opportunities. We have so much to cover. It is of course the Exponential Era private equity investment trends that we'll be covering, and I would like to introduce you to our panellists here, John Shin, Pete Seligman, Nick Kelly and Martin Tang. We're going to be covering so many things just to get you hungry for what we'll be discussing here. The Australian context and opportunities and challenges of private equity. We'll also touch on growth equity, succession planning, software tech, and access for different investor types. But to get straight to it, we will go for a broader overview. I'm going to ask Nick Kelly first, given his overview of alternative. Nick, from your perspective at Wilson Asset Management, how would you characterise the current state of the private equity market in Australia? Also, what are the most significant trends you're observing and how are they impacting investment strategies?
Yeah, thanks Lel. So for those of you who are not aware, so I manage the Wilson's Alternative listed investment company within Wilson Asset Management. So it is a listed investment company that invests across all elements of private markets, so across private equity, real estate, infrastructure, agriculture and water, and finally private debt. And importantly, it's accessible to everyone in the market, from retail investors through to wholesale and institutional. So in terms of the trends in the market that we're seeing, so expecting this year to see an increase in deal flow in the private equity space. I feel like a bit of a broken record on that one, but we do think deal flow will tick up this year. It does feel like there's quite a bit of fatigue from people sitting on the sidelines, so I think we will see a tick up in deal flow. We think that deal flow will be focused on the mid-market and particularly in growth equity. I think the larger cap deals will be difficult to get away unless we see further easing from the RBA, although given the rhetoric last week, I'm not holding my breath that there'll be more of that anytime soon. And finally, this theme that we've seen around private companies staying private for longer, we think that will continue. There was a report some of you may have seen yesterday from ASIC on the intersection of public and private markets. Talked about this trend of a lack of listings being more cyclical. I don't think that's the case. I do think it's a bit more structural. For those that are not aware, there's about half as many listed companies in the US as there were 30 years ago, right? So it was about 8,000 30 years ago, there's 4,000 today. So I think we'll continue to see that trend around private companies staying private for longer, but transacting through trade sales, other private equity firms buying out businesses, and adjacent businesses buying businesses too.
Thank you. I can also certainly vouch for what you're saying because I'm the managing director of the Stock Network and also a member of the IPO network, and IPOs are at record lows, not just in Australia but overseas. So everyone is looking at alternative options, and perhaps on that international perspective, Martin, it would be great if you could give us your experience of Southeast Asia and how does the Australian PE market compare to other regions? Also, if there are unique opportunities or challenges here, particularly in terms of deal flow, valuations and exit strategies. What differences are you seeing?
Thanks, Lel. That's quite a mouthful. I'm Martin, co-founder and partner of Genesis Alternative Ventures. We are a private credit fund headquartered in Singapore. We specialize in providing venture debt as well as growth debt to startups, Series B onwards, to mid-market companies. The Australian market is very interesting. I was educated here. It's a sophisticated market. There is governance. There's rule of law. These are all very important for us as investors. And there's the spending power. Australians are rich. There's a lot of buying power here. And compared to Southeast Asia, there's reasonable scale as well. So I've been so impressed and always been very, very surprised at the kind of deals that I've seen in Australia. Never mind the Canvas, Atlassians of the world, but there's this other bunch of hidden gems that I'm working very hard to uncover and hopefully work with my partners on the panel here to uncover these gems. In terms of valuation, there will always be companies that are overvalued, right valued, undervalued. It really depends on who you're talking to. If you're a buyer, it's always too expensive. If you're a seller, it's never enough. So I guess at some point, there has to be a meeting of minds, and if there is the willingness to do a deal, things will get done.
Excellent. Nothing like different perspectives, and it's incredible to have yours including Asia. Moving on to another perspective now from the SME sector. John, you're focused on Australian SMEs. Can you outline what makes this segment attractive for private equity investment, and also what the specific hurdles are that you encounter in investing in this space, perhaps with consideration to things like succession planning and growth capital needs?
Yeah, thanks. Look, I think that SME sector in Australia is a very large sector. I think we all can see, maybe in this room, a lot of baby boomer owners of those businesses. I think I've seen stats of, $3 to $4 trillion of value in that mid-market in Australia. And they're often businesses that are too small to list on the stock exchange or to deal with a large private equity firm. The challenges, though, are often they're run by the founder and, the person that created the wealth, the person that drove the team to create all the success is also the person who's going to be retiring and selling. So a lot of what we do in private equity is we align ourselves with great people, people on the board, people on the management team, people as shareholders, and we make sure that we align ourselves with those people. And really, that's half the challenge of private equity. It's funny, we can't choose our son-in-laws or daughter-in-laws. We get told who that's going to be. But with private equity, you can choose. So you can choose a fund, and the fund manager will put together a portfolio, and hopefully that fund manager has a lot of skill in how they assemble that portfolio. Or you can do it. And most of you are in this room because you've created wealth in some way. I would say to you, use the skills that you've built over the time to be able to make really good choices. Make good choices about who you're backing as the private equity manager. Make good choices about who the CEO is. Make good choices about the industry that you're going to be in. And if you can do that, you'll get a lot of the tailwinds of buying these businesses that are hopefully growing.
Thank you, John. You mentioned that boom in baby boomer businesses that are coming to market, people looking to buy, and moving on to that entrepreneurship through acquisition. This is a question for Pete. You've got a unique perspective because you have both acquired businesses and are now investing in others that are doing the same. Can you outline what the key success factors are for this, and also how it differs from the traditional approaches to private equity?
Sure, thanks. I was waiting for it because I was kind of the last one left to fall there. So yeah, entrepreneurship through acquisition, ETA, it's an acronym that not a lot of people have heard. The biggest difference to private equity is exactly the issue that we heard about just then, with the fact that the businesses that we're targeting to acquire are owned and operated by the retiring owner. And so there's that succession play that doesn't exist. When we invest in ETA, we're investing in the entrepreneur first and the acquisition second. So what we're doing is we're picking effectively another way to speak about it, and we've got some in the room, so I don't want to refer to them too much as jockeys, but it's like picking the jockey before the horse rather than the other way around. And then we back that person through their search process to then identify a good acquisition for them to buy. Then it means that post-acquisition, you've kind of solved that succession play along with the capital. So I think that's the predominant difference, and that allows for, we were talking about numbers just before. The Australian Business Growth Fund just issued a report which covers a range that's slightly bigger than what we'd probably focus on, but it estimated that for small businesses with revenue between 2 million and 100 million that are headquartered in Australia and privately owned, there's currently about 165,000 of those in Australia at the moment. So it's a large pool of businesses that are of a material size. Now, all the statistics we get from surveys say that, and I won't give exact numbers, but a large majority of those owners don't have a succession plan, and a large majority of those people, if asked, would sell. And so over the next, say, 5 to 10 years, we're going to have to see something happen with well over 100,000 businesses with revenue of 2 to 100. And private equity's got a part to play in that, but there's a level at which they can't go below because it just doesn't make sense for the model, and that's where ETA comes into play.
I'm going to ask you a question now which may be at the back or front of people's minds that are here, given that there may be a number of business owners or people that are looking to buy an asset. How long do you think someone should give themselves to prepare ahead of giving up their asset for sale?
So if you're a business owner, how long will it take you to prepare for sale?
Yes.
So obviously it depends on the maturity of your business, but I would allow years. So I was on a panel a couple of weeks ago with someone that spends a lot of time with family office and a lot of time thinking about succession of the operating businesses owned by those family offices. Her recommendation is 8 years, at least 8 years in prep for that full succession of the founder owner. But you need, not only do you need to establish an operating rhythm that allows you to provide consistent results, but then you need those consistent results to come through. The biggest issue that we often find is that we'll come across a potential acquisition, and a lot of the work that needs to be done in order to shape that for sale is actually done in partner with the buyer. Which is okay, and that'll happen on a lot of cases, but I'd say at least 3 years would be the runway if you're looking at exiting.
And by contrast, what you usually see from people, is it 3 to 8 years?
No, like usually 0. Usually,
Yeah.
Oftentimes it'll be that they haven't even thought about it. They don't know what their succession plan is. They're trying to work out how they can exit. Then finally it gets to the point where they actually really need to exit. And unfortunately for a lot of these owners, it's usually something like a health scare on their own part,
Yes.
or a loved one. And that then gets really difficult because then you're forced into that situation. So unfortunately, a lot of them get accelerated beyond the rate that they should be exiting.
Yes, and I suppose therein lies the opportunity for the suitors or yourselves. I'm going to head back in the same order that we came and to ask John a question for yourself. You've got experience across various asset classes. How does your background in real estate and venture capital inform your approach to private equity investing in SMEs? And also, you advise Stephen Lowy at LFG. Are there specific sectors or themes within private equity that are particularly attractive to family offices and high net worth individuals right now?
That's a good question. Look, one of the frameworks that we have is to look for growth tailwind assets. And the reason why we look for that as a family office investor is one of the things that you have that others don't in the listed markets is duration. So if you can find an asset or a subsector that you think is growing, that will hopefully grow despite lots of other macro events. Maybe you'll get the time estimation wrong, but you're pretty sure that the thing you're betting on will grow. Well, that's a huge advantage. And you've heard a lot of adages of put it in the bottom drawer and let it compound. Compounding and diversification are the two sort of magic things of finance. But if you can find an asset and let it compound and let it grow, well, that's a really great place to be. And so I think there's some really skilled investors that can buy really well. There's some really skilled investors that can buy distress and turn it around. There's lots of different things, but I think one of the keys that we really always focus on is their long-term growth. The other would be people. I think the first part of my career, I was always focused on the transaction. What are the numbers? What does the spreadsheet say? I think in my last decade, I would spend much more time around the people around the deal. So we've vetted many deals and walked away because the people were not the right people. In finance, there's some amazing salespeople, amazing. Beware the great salesman. But always do as much work as you can around every single person around the deal. Because if you can find an industry with a tailwind and really great people, and then probably one more thing is the right deal structure, that you're paying the fair price for the returns that you're seeking, then hopefully you can hold it for 10 years and let it compound wealth.
It's so true. I love what you say about salespeople. I have interviewed hundreds of CEOs, and I always note that the strength of a sales pitch is not aligned to the strength of a share price. And moving on to listed equities, Nick, that is clearly what Wilson Asset Management are known for. What motivated the expansion, though, to alternative assets, and how do you see private equity fitting into a broader portfolio strategy for different types of investors? You also mentioned giving everyone access to alternative investment managers. Can you elaborate on this democratisation of private equity and how Wilson Asset Management is approaching this?
Yeah, sure. Thanks, Lel. So Jeff being Jeff, was pretty opportunistic in his approach to effectively taking on this fund almost 5 years ago. But more than anything, I think Jeff, like many of us, have seen this trend towards alternatives, and the fact that retail investors, relative to sort of wholesale and institutional investors for that matter, haven't been able to access alternatives in the same way. Just looking at the allocations of the average mum and dad investor to alternatives, it's much, much lower relative to institutional investors, and so there was a real opportunity there to grow, to invest into a space that was growing, but also to your point around this idea, and we hear this term a bit, this sort of democratisation of private equity, which is really just giving everyone access to an asset class and strategies that they were once unable to access because it was the domain of the institutional investors. And so that's what we've been able to do with WMA, and it's really exciting that we're able to invest with best-in-breed investment partners and give retail investors, mums and dads, access to those investment partners that they frankly just can't access otherwise.
Yes, I've interviewed one of your colleagues, Dania Zinurova, and I'll never forget, she told me once that her son, who's younger, asked her, "What do you do?" And she was driving on a road, and she said, "I buy things like this road, and you can do that too one day." And I thought it was just the best, simplest explanation of how we can diversify our portfolios. Martin, if I can ask you, you pioneered venture debt in Southeast Asia. While venture debt isn't strictly private equity, as there are lessons learned from that experience that apply to the current PE environment, particularly in terms of structuring deals or managing risk. And also, given the rise of software and technology from a venture debt perspective, are there valuation metrics changing on how to value software businesses?
Again, a mouthful. So I'll take that first. So venture debt, private debt, all belong to the alternative asset class. So similar to private equity, we are always buying the people, business models, whatever, they come, they go, but we're very, very focused on people first. Then we look at what the financials, the numbers tell us. I think that's very, very key. It's challenging because in private markets, there's little to no regulation on what needs to be disclosed. So we spend a lot of time on due diligence, in-person due diligence, third-party due diligence. We do informal checks, and the informal checks are always very interesting. And these days, I call it open source intelligence as well. Go check their Instagram, go check their Facebook. How are they spending their weekends? How are they spending their time? What are they buying? Or are they saying silly stuff on X? These are all very, very crucial, critical data points. Switching gears to valuation metrics, I'd say after the last 2-3 years of the so-called funding winter that we saw in the private markets, valuation multiples have come off somewhat. There's still a lot of founders that are drunk, hungover, still expecting 10 times sales multiples. Those guys will continue pitching, but there are the sensible folks who say, look, if we don't raise, it's the end of the road for us. Let us take some pain on valuation. Let's recap the company, but rebuild something that's more sustainable, that will give our investors a good return at some point in time.
Yes, and I just love hearing professional investors warn people about social media, because I think so many people think that their business and personal is separate until it comes to assessing an investment, and it's all open for assessment online. Now, as we move into the last part of this, I would love to hear everyone's opportunities and red flags when it comes to private equity. Let's go to the red flags first before we head to the blue sky. And perhaps Martin, starting with yourself, looking ahead, what do you think is a red flag in this sector that we should be aware of?
Well, I think the one big red flag that's been talked about a lot would be the level of disclosure, especially in private markets in general. And that will continue. There will be blow-ups, there will be frauds. So I think the posture for any potential investor would be, what's the worst case, what's the downside for me if things don't go according to the prospectus?
Yes. How about yourself?
Yeah, I think somewhat adjacent to private equity, but will have a direct impact, is I'm pretty concerned about the amount of capital that's been invested into the private credit market. I know there's a panel coming later on that, but the ramifications of increased defaults. We've been through a fairly benign default cycle. I think defaults will rise. I think there's some lending practices that have gone on that are going to come under stress, and we'll definitely see those groups who are skilled and those who aren't as they work through some of those loans. And the flip side of that, on the opportunity side, which I know you wanted to come back to, is I think there's potentially a role there for distressed credit. So I think that could be an interesting space.
Pete, what red flags are you waving this year?
I think I'm involved in, I guess what you could say is a relatively nascent asset class. And I think the red flag for me is just watching that market or that community build over the next few years. So, you know, if there are a few transactions that have been done, there's more transactions that will come. I think the deal flow comment is a good one this calendar year. But we've just got this massive volume of, as I was saying before, potential deals to be done over the next 5 and 10. It's just matching those spinning plates up at the right rate, because there's lots of actors that need to be involved in that process, and to the extent that those aren't balanced, then that just creates some volatility. So it's just getting, you know, vendors, equity, debt, entrepreneurs, like getting that running at the same speed is the hardest part.
Yes. And John, warnings or red flags for yourself?
Look, I think private equity, everyone has to understand, is an illiquid asset class. So I think if you're not investing with a 10-year horizon, even if it says 7 years, but normally there's all different things that they can do to extend the investment horizon. So if you don't have the capital that you can comfortably say, I'm going to invest in this and I'm going to invest in it for 10 years, it's probably not the outright asset class for you. You can find it in other ways, like other vehicles, but private equity in its essence is buying private businesses. So you need to know that that's illiquid. Maybe you'll get distributions, maybe not, but it's an illiquid asset class.
That's a very important warning. And how about on the flip side, opportunities or areas of this sector that are exciting you in the year ahead?
Look, I think there's a lot of reasons to be very optimistic. You know, I think we're now starting to see businesses that are going to use the benefits of technology to drive productivity and reduce expense. You know, AI is a buzz term. There's lots of venture capital around it, but we're now starting to see it actually go into businesses and drive, hopefully, increased revenue or cost. And I think this succession of baby boomers driving to the next generation of management, the key thing is finding great people and then aligning them to the outcomes like investor outcomes. And if we can do that and unlock it in really interesting businesses, I think there's a great opportunity to create a lot of wealth.
Pete, opportunities in your eyes for the year ahead?
Yeah, I think for the year ahead, but also for this next kind of 5 or 10 year period, it's similar to the comment just then. I think that there, on the risk side, there's a risk that there are hundreds of thousands of businesses that just shut their doors because they don't have any other option. The awesome opportunity is if we can connect the capital and the entrepreneur and those businesses together in the right way, we can actually get that part of that critical part of our national economy to continue on and then go to the next stage. So I'm really excited by looking for the opportunity to to get those connections to happen so that those entrepreneurs have an opportunity to have a crack at the next phase of those businesses.
And Nick, you earlier referenced an opportunity. Can you expand on that, or any other pathways that excite you in the year ahead?
Yeah, sure. So I think, as I said, the distress piece I think will be an opportunity. Tends to be more a cyclical asset class, especially in Australia. Given the size of this market, the US is a bit different. You can have a sort of consistent allocation. Probably the other piece is agreeing with these guys that succession piece. I think that's where we'll see much of the deal flow in the private equity market, and hence our focus on that mid-market growth equity space.
Excellent. And finally, Martin.
With the funding winter, with inflation, a lot of companies have learned to do a lot more with less, reduce their expenses, their burn, and AI has also helped that. So we see a lot of opportunities to deploy capital into right-sized companies that are optimizing their resources.
Wonderful. Thank you so much to our panelists and our audience for joining us with private equity investment trends, the exponential era. I hope that we've given you many, many ideas to make you very hungry for investing, and it is, of course, lunchtime, so we hope you enjoy your lunch as well. Thank you very, very much.
Thank you.